Cash and digital currency, debit cards, credit cards and the money supply, section B. This video is a follow-on from the previous video which dealt with cash and digital currencies. If you haven't seen that video, I'd recommend you doing so before watching this one. In this video, the focus is going to be on debit cards and credit cards and the money supply. Debit cards can be regarded simply as a means of paying for products. They are a payment system. You buy a product online or in store and the funds are debited directly from your accounts, hence the name. It's fairly straightforward stuff. Debit cards are convenient and relatively safe. They are easier and safer than carrying around cash, especially with regard to big transactions. And the new contactless system now in operation makes paying for products even easier. Let's turn our attention now to credit cards. Credit cards and debit cards might appear the same, but they operate in very different ways. Both debit cards and credit cards can be regarded simply as a means of paying for products. They are each payment systems. According to Investopedia, a credit card is, open quotes, a tool to use in place of a cheque or cash, close quotes. But credit cards are not just another form of payment system. There is more to them than this. Debit cards enable people to pay for products by debiting the funds directly from their accounts. By contrast, when you use a credit card, you are basically borrowing currency from the credit card company, be that a bank or otherwise. The credit card company is essentially extending a line of credit to the customer. Maybe I'm wrong in saying this, but my guess is that that's the reason why they're called credit cards. The amount borrowed by the credit card the credit card balance, can therefore be regarded as a short-term loan made by the credit card company to the holder of the card. And importantly, with credit cards, there's interest attached to the balance. Annual percentage rates, APRs, vary but can be fairly steep. Interest rates are the primary driver for company revenue. So, credit cards can also be considered as debt instruments. The holder of the card is given a debt facility, an ability to get into debt. This debt will obviously have to be repaid at some point. If you're wealthy, you can repay the debt without any real problem. The debt will not be much concern to you. But if you're not wealthy, you might struggle to repay the debt sometimes. And for many people who can ill afford it, credit card debt can be a real problem. The other point to make with regard to credit cards is to do with personality or how you choose to use them. If you're a sensible, prudent and cautious person, and if you use them wisely, then credit cards can be very useful. If, on the other hand, you are not a sensible and prudent and cautious person, and if you don't use them wisely, then credit cards can be problematic. Those people who are not so disciplined might find themselves in financial difficulty. It stands to reason then that credit card companies don't care quite so much for people who are sensible, prudent and cautious, people who do not serve their business model as well as other sorts of people. They still make money with the former, people just not quite so much money as they do with the latter. Safe to say they probably prefer people who are less prudent about their spending habits. Also, while they appreciate those people who are timely with regard to their monthly repayments, they won't make so much money on these people compared to those that pay late. Big spenders who are relatively wealthy are probably the premium customers. The prudent people probably make up the core of their business. These people represent the reliable source of revenue. And then there are the less prudent people who add to their revenues disproportionately to their number. But these people also represent a risk. Credit card companies do face problems when it comes to people who run up huge debts and are financially delinquent. Having a credit card creates an illusion of wealth. Generally speaking, debt is not wealth. I'm aware that there are people who borrow large sums of currency from banks in order to turn a profit by investing the currency in some scheme or other. But what I'm talking about here is the ordinary person. I'm not a huge fan of the banking community, as you might have already guessed. Bankers or banksters act in a predatory and parasitic manner. They prey on people, they take advantage and cause malaise. Debt is the product that the banks are selling. A butcher sells meat, a baker sells bread. A banker, be they the ordinary high street banker or central banker, are in the business of selling debt. Debt is how they make their money. Credit cards are debt instruments, and they were no doubt devised by banksters in order to get people in debt. We live in a debt-based system because the banksters wield untold power nowadays. Compare this state of affairs with debit cards. So as long as you have sufficient funds in your checking account or current account to cover the purchase, then all is well and good. You might even have a pre-arranged overdraft facility. In either case, the purchase will be declined if you go over a certain limit. Moving on. The cash and digital currency, debit cards and credit card balances combined, as well as all manner of loans, go to make up the total amount of currency in circulation in a country. There are different criteria used by economists when they talk about the money supply, the amount of currency in circulation in a country. M1 is the currency in circulation, which includes cash, demand deposits and checking accounts. For British audience, this would be the current accounts. It also includes travellers' checks. These are the more liquid deposits, easily converted into cash. M1 is the narrowest measure of the money supply measurements. M2 is a slightly broader definition. It includes M1 as well as saving deposits of less than $100,000. So these are the interest-bearing savings accounts. M3 is a slightly broader definition still. It includes M1 and M2 as well as holdings larger than $100,000. It's more associated with the larger financial institutions and corporations rather than small business and individuals. These measurements are US based. Also, it should be called the money supply. It shouldn't be called the money supply. It should be called currency creation. There are a couple more points I wish to make before finishing. In terms of safety, credit cards are somewhat more safer than debit cards because there is a guarantee on purchases which debit cards do not necessarily have. Credit cards offer better levels of protection for the consumer against fraud and such like. This is obviously a good thing, but I'm somewhat suspicious about the intentions of credit card companies. There's an element of incentivizing behaviour. I suspect that they want people to use credit cards rather than debit cards because they make more money from credit cards and they are in the business of selling debt. And this is then a reason for them to offer incentives to alter consumer behaviour. Anyway, this is a relatively minor point. My next point is not so insignificant. While debit cards and credit cards might well be convenient and safer than cash, for me they represent part of the war being waged against cash by the banksters on behalf of our overlords. Governments and central banks want to introduce national central bank digital currencies, CBDCs, so maybe, for instance, a dollar coin in the States. It should be said that in some respects these cryptocurrencies won't be much different to the currencies now in circulation because, as I said in the previous video, the currencies we use now are more or less digital anyway. Cash only accounts for a very small percentage of currencies in existence. So why then do governments and central banks want to introduce CBDCs? Well, for two principal reasons. The first reason is control. Our overlords love control. Our overlords don't like cash mainly because it's beyond their control. Cash is somewhat anonymous and invisible. They don't as yet have full control. However, by eliminating cash altogether and making the economy 100% digital, they can gain a great deal of control. Cryptocurrencies, though are the mechanism by which they will be able to gain complete control. Cryptocurrencies are much more efficient and all-encompassing than ordinary digital currencies. Basically, CBDCs represent the completion of a control grid system. If you want to get an idea of what this might look like, you only have to turn your attentions to China and what the CCP have done with regard to their CBDC and their social credit system. I don't know about you, but it's not the kind of system I want to live under. Anyway, make no mistake, complete control is their ultimate aim. This, by the way, is one of the reasons they don't like gold and silver either. Precious metals are held in people's possession are beyond the control of our overlords. Silver is the people's money, and our overlords don't care much for we the people. If you're still not persuaded by my arguments, perhaps you might consider what happened in Canada recently, where the authorities turned off people's ability to access funds because some actions some people took went against government directives. This is a proven real-world example of the kind of control they mean to exercise. You have been warned. Submit or resist. The choice is yours. The second reason is that some cryptocurrencies like Bitcoin and Litecoin are decentralized and they therefore present a very real existential threat to governments and central banks' currency creation racket. If governments and central banks can introduce their own CBDC, then this will go some way towards meeting that threat. I'm sure that there's more that could be said and should be said about all this, much that I've missed out, but that will do for now. Wise up and rise up.